The presentation would focus upon a background, the overview of the VAT, how the VAT will work, its main features for the Federation, and then a summary. As noted before, we almost appreciate that our economy has transitioned over the years from one that was heavily based upon sugar production now to one where the leading sectors are financial services and tourism. The current tax system is fashioned, however, to a large extent on the leveling of duties on imported goods. In this regard, the government commenced a tax reform and modernization exercise. Reform is necessary to remove inequities within the tax system, and the modernization would be focused on realigning our tax system to reflect the new realities of our economy. The introduction of VAT in November 2010 is one element in our tax reform and modernization exercise and is intended to replace other indirect taxes. Again, we must stress that the objective of the VAT is to make our tax system simpler and more efficient. As highlighted again before, the review of the existing taxes include the excise tax, the business tax, and as disclosed in the Prime Minister's address on Labor Day, the corporation tax. The next aspect of the white paper dealt with an overview of the current indirect tax system. Indirect taxes are levied on consumption at different rates. These include, for example, the hotel and restaurant tax and the consumption tax, just to name a few. Indirect taxes are applied mainly on goods and services. This has resulted in efficiencies and inequities within our system. Firstly, exports are adversely affected because they contain a large element of domestic taxes. And two, there is no provision for refund of taxes paid on inputs that go into the local distribution or production of goods or services. With regards to an overview of VAT, we all must remember that VAT is a tax on consumption. It is charged on the value of imports and on the value added on goods and services. VAT is not an additional tax on businesses. VAT is a broad-based indirect tax charged and collected through the distribution chain with the provision for businesses to offset the VAT paid on their purchases. So VAT will not be paid on VAT. VAT will be levied on imports through customs, transactions between businesses and the final consumer, and on selected transactions with some government departments. Now, if you could see on the slides before you, this is an example of how taxes are calculated. The item displayed in the black font outlines our current consumption tax system, where here we are looking, for example, how the tax is computed for a stove that is imported and sold in the Federation. First, when the item is imported through customs, the CIF value for the stove we assume is $1,500. The import duty on such an item is 25%. So therefore, the amount to calculate consumption tax is $1,875. Thereafter, the consumption tax is applied to that imported stove, which amounts to 22.5%. Then the custom service charge is also levied on the CIF value, which is $90. Then, therefore, the cost of landing the stove to the retailer is $2,386.88. We assume that you add a markup on that item of around 35%. and that would give a final selling price to the consumer for $3,222.29. Under a VAT system, you realize there will be something that is much different. The VAT system is displayed in the red font. Assume the same CIF value of the imported stove, $1,500. The import duty on this item is 25% of this amount. The custom service charge would be 6% of the CIF value. So therefore, the total amount to calculate the VAT upon is $1,965. VAT would now be computed upon that amount. We assume for ease of calculation that the VAT is 50%. So it will be 15% of this amount, which amounts to $294.75. The retailer's cost prior to markup is $1,965. Again, VAT is not charged upon VAT. We assume then the markup is around 35%. Now this would give the retailer's price subject to VAT to be $2,652.75. We assume that the output VAT will be applied on this base at 15% of the amount. This gives a final selling price to the consumer of $3,050.66. Under this example, you could recognize that the consumer would save at least $171.63 with the introduction of a value-added tax.